In today's rising interest rates and potential inflation worries, income-focused investors are exploring alternatives. Enter high-dividend ETFs. These exchange-traded funds bundle together a basket of equities noted for their steady dividend payouts. But with a global market at your fingertips, which ETFs offer the best balance of yield and diversification? We'll analyze the top 6 high-dividend worldwide prospects for 2024, helping you navigate the exciting world of income investing and potentially supercharge your portfolio's cash flow. Number 6. Vanguard International High Dividend Yield ETF, VYMI. Offering a current dividend yield of 4.52% as of March 25, 2024, and a competitive expense ratio of 0.22%, VYMI is a well-established option for income-focused investors wanting exposure to mature international markets. This ETF tracks the FTSE High Dividend Yield Index, which chooses companies from industrialized countries outside the U.S., with a concentration on those having above-average dividend yields. Launched in 2007, VYMI boasts a strong track record, providing investors with a chance to benefit from the development potential of worldwide markets while also getting a stable source of dividend income. Looking at historical performance, VYMI has provided a relatively stable performance over the previous 5 years, averaging an annual return of roughly 8%. It's crucial to remember, however, that past performance is not a guarantee of future outcomes. The international concentration of VYMI also suggests it may be more subject to currency movements than domestic ETFs. Number 5. SPDR S&P Global Dividend ETF, GDO. Beyond the previously stated possibilities, the SPDR S&P Global Dividend ETF, GDO, offers another intriguing selection for income-focused investors seeking global exposure. With the current dividend yield of 4.71% as of March 25, 2024, and an expense ratio of 0.47%, GDO provides a cost-effective method to get into a basket of dividend-paying champions. Unlike some high-dividend ETFs that prioritize raw yield, GDO adopts a more sustainable strategy by tracking the S&P Global Dividend Aristocrats Index. This index focuses on established corporations from developed markets outside the U.S. with a history of increasing their dividends for at least 10 consecutive years. This focus on dividend growth might be particularly enticing for investors seeking a dependable and potentially expanding income stream. Historically, GDO's performance has followed VYMI to a certain extent, with an average annual return hovering around 9% over the past 5 years. While previous performance doesn't guarantee future outcomes, the emphasis on established firms with a track record of increasing dividends might give some stability compared to high-yield funds that may be more sensitive to short-term swings. Number 4. iShares Emerging Markets Dividend ETF, DEM. While the previously stated ETFs offer attractive options for income-focused investors seeking exposure to established countries, a diversified portfolio can consider adding a touch of emerging markets for potentially better yields. Here, the iShares Emerging Markets Dividend ETF, DEM, is spotlighted. DEM offers investors a chance to tap into the economic potential of developing countries through a basket of dividend-paying firms in those regions. This might be particularly enticing for income seekers, as developing market equities frequently boast greater dividend yields than their developed market equivalents. Currently, DEM enjoys a tasty dividend yield of roughly 5.12%, leading to potentially higher and more frequent cash flow for investors. However, with this potential for higher returns comes a key caveat. Emerging markets are inherently riskier. Political instability, currency fluctuations, and less developed regulatory systems can all lead to more volatility in stock values. This translates to DEM's historical performance being bumpier compared to developed market ETFs. While the average annual total return over the past 5 years averages around 7%, investors should be prepared for potentially considerable year-to-year changes. Therefore, adopting DEM into a portfolio requires careful study. While the greater dividend yield is attractive, investors should ensure their risk tolerance fits with the inherent volatility of emerging markets. A lower allocation within a more significant, globally diversified portfolio can be a wise method to balance the possibility of higher income with the added risk. It's vital to remember that past success is not a guarantee of future results, and emerging markets might face periods of substantial turbulence. Consulting with a financial professional can help assess if DEM corresponds with your overall investing goals and risk profile. Number 3. Franklin FTSE Europe High Dividend UCITS ETF, FDEU. Rounding up our list is the Franklin FTSE Europe High Dividend UCITS ETF, FDEU, presenting a tempting option for income-focused investors seeking exposure to European markets. This ETF boasts a dividend yield of 5.38%, much more significant than many US-based choices. This is mainly due to structural differences in European economies, where dividend payouts are generally more common than stock buybacks. FDEU concentrates on firms with a history of generating stable dividends, allowing you to profit from a steady source of income potentially. However, it's crucial to understand the trade-offs. European markets can exhibit different risk profiles compared to the US. While FDEU gives exposure to developed economies, historical performance demonstrates somewhat modest volatility. The average yearly return over the past 5 years is around 6%. This correlates with the more significant European market trends, but may not offer the same growth potential as other high-flying US firms. The expense ratio for FDEU is 0.39%, which is quite common within the ETF market. Remember, this cost may vary slightly based on the precise share class you purchase. Ultimately, FDEU is a beneficial choice for investors seeking a balance between income production and geographic diversification within a mature market framework. Number 2. Nuveen Global High Income ETF, GHII. Packing a punch with 6.14% dividend yield, GHII employs a comprehensive approach to grab income possibilities internationally. It methodically curates a basket of high dividend-paying companies meticulously selected from developed and emerging economies. This global diversification broadens your exposure to possible income streams across established and growing economies. Furthermore, GHII combines real estate investment funds, REITs, and business development companies, BDCs, under its holdings. REITs own and run income-producing real estate, while BDCs provide finance to small and medium-sized enterprises. These inclusions have the potential to enhance GHII's yield potential further. However, it's vital to realize that a more extensive perspective generally comes with a disclaimer. GHII's past performance reflects the naturally higher risk linked to its high-yield strategy. While the average annual return over the past 5 years has hovered around 8%, investors should be prepared for significant year-to-year fluctuations. The price movements of these underlying assets can be more volatile than established blue-chip stocks in developed markets. This volatility can be attributed to various factors, including fluctuations in global economic conditions, currency exchange rates, and the inherent risks associated with emerging markets. Number 1. SPDR S&P Global High Dividend ETF, RENO. Stealing the show with the highest dividend yield on this list at a staggering 6.47%, RENO embarks on a global quest for income across developed and emerging markets. It achieves this by meticulously selecting companies with a well-established track record of consistently paying dividends. This focus on dividend aristocrats, companies with a history of increasing their dividends year after year, provides a degree of stability and predictability to your income stream. Beyond its focus on dividend stalwarts, RENO incorporates a value tilt. This strategic investment approach involves selecting stocks that appear to be undervalued based on traditional valuation metrics like price-to-earnings ratios. The fundamental premise is that these seemingly underpriced companies have the potential for significant price increases in the future, thereby magnifying your total returns. However, like GHII, RENO's historical performance reflects its heightened risk profile. The average annual return over the previous 5 years hovers at 7%, but with the most extreme year-to-year fluctuations among the ETFs studied. This volatility can be attributed to the factors mentioned for GHII, along with the additional risks associated with a value investing strategy. Value stocks can underperform for extended periods, particularly during bull markets when growth stocks tend to outperform. The world of ETFs offer a vast array of investment opportunities. By understanding your risk tolerance and financial goals, you can select ETFs that align with your investment strategy. Remember, investing involves risk, and you should always consult with a financial professional before making any investment decisions. Share your favorite ETF in the comments section, or if you would like to highlight any other ETF that is worth considering in this list, please feel free to include it in the comments as well. Like this video, subscribe to our channel, and follow us for more financial education content to make informed investing decisions. Thanks for watching.